A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It presents a summary of a company's assets, liabilities, and shareholders' equity, and is based on the fundamental accounting equation: assets equals liabilities plus shareholders' equity. Here's a breakdown of the components typically found on a balance sheet. Assets. Assets represent what a company owns or controls and can be categorized into two main types. A. Current assets. These are assets expected to be converted into cash or consumed within 1 year or the operating cycle of the business. Examples include cash and cash equivalents, accounts receivable, inventory, and short-term investments. B. Non-current assets. These are assets with a longer useful life that are not expected to be converted into cash within the next year. Examples include property, plant, and equipment, long-term investments, intangible assets, and long-term receivables. Liabilities. Liabilities represent what a company owes to external parties, such as suppliers, lenders, or other creditors. Similar to assets, liabilities can also be classified into two main types. A. Current liabilities. These are obligations that are expected to be settled within 1 year or the operating cycle. Examples include accounts payable, short-term loans, accrued expenses, and current portion of long-term debt. B. Non-current liabilities. These are long-term obligations that are not due for settlement within the next year. Examples include long-term loans, bonds payable, deferred tax liabilities, and pension obligations. Shareholders' equity. Shareholders' equity represents the residual interest in the company's assets after deducting its liabilities. It can be broken down into the following components. A. Common stock. The par value of the company's issued shares. B. Additional paid-in capital. The amount received from investors above the par value of the shares. C. Retained earnings. The accumulated profits or losses of the company since its inception, minus any dividends paid. D. Treasury stock. The company's own shares repurchased and held. E. Accumulated other comprehensive income. The cumulative gains or losses that have not yet been recognized in the income statement. The balance sheet follows the equation: assets equals liabilities plus shareholders' equity. This equation ensures that the accounting equation remains balanced, representing the sources and uses of funds. By analyzing the balance sheet, investors, analysts, and stakeholders can evaluate a company's liquidity, solvency, and financial health. It provides insights into the company's ability to meet short-term obligations, the composition of its assets and liabilities, and the shareholders' stake in the company.